I want to tell you about a phone call I'll never forget. I was sitting at my desk at Merrill Lynch and my phone rang. It was a client. He owned a brewery and he was a private airport owner. Brilliant man. I made over $500,000 a year, sometimes significantly more. And he had a portfolio that's his collection of investments worth well over $15 million. And he was screaming at me to sell a majority of his stocks. The market had dropped, not crashed, dropped. And this man who could stay calm while running a multi-million-dollar business, who made high stake decisions every single day, was in full panic. He wanted mostly out of all of it, stocks, bonds, everything. Like, he wanted to put everything into a money market, into cash, like right now. I tried to talk him through it. I showed him the data. I reminded him of his long term plan. I explained that selling at the bottom is how you turn a temporary drop into a permanent loss. He wasn't hearing any of it. Fear had taken over his brain. It's the same fast, emotional, automatic response we talked about in 2 episodes ago. And what psychologists call system one thinking, the part of your brain that reacts before it reasons. His slow, logical brain, which is system two, the part he used to run his business, was completely shut off. So, if you need a recap, I highly recommend you see that episode on System 1 and System 2 thinking. It's the two brains. Highly recommend it and give you a lot of perspective into what I'm going to go over. In any case, he sold all of it. The market came back within 18 months. His investments would have been worth more than before he panicked. Instead, he locked in his losses, meaning the drop that was only on paper became real because he sold, sat in cash while everything recovered. And then, and this is the painful part, he bought back in after the recovery at higher prices than where he sold. His fear made the first decision, then the fear of missing out, what people call FOMO, made the second. Neither decision involved actual thinking. I tell you this story because right now, this exact scene is happening across America. Oil just crossed $80 a barrel. Gas had its highest single day spike since March 2022. The Dow has dropped over 1,200 points in a single session. Airlines are getting crushed. The Strait of Hormuz, a narrow waterway of Iran's coast, where 20% of the world's oil passes through, has basically been shut down. And millions of people are looking at their retirement accounts and investments and their bank balances and feeling the exact same thing my client felt: pure terror. Today, I'm going to teach you how to not be that client, how to think about money during a crisis the way professionals think about it. Not with emotion, but with a system. Because right now, the most expensive mistake you can make has nothing to do with oil prices. It has everything to do with how your brain handles fear. I'm Mike Aponte, also known as M.A. Aponte. I'm a former Merrill Lynch BlackRock wealth manager, and today we're going to be focusing on your money. And this is Thinking to Think. Before we talk about psychology, let's talk about what's actually happening. Because the first step in the clear protocol, from what I mentioned in episode Your Feed is Lying to You, Critical Thinking During the Iranian Crisis, is separating facts from feelings. So let me give you the facts as of this recording, and that is the oil and gas picture. When the US and Israel struck Iran on February 28th, oil prices jumped immediately. Brent crude, that's the international price that most of the world uses as a benchmark, went from around $70 to over $80 per barrel in just a few days. That's a jump of more than 13%. US crude crossed $80 for the first time since January 2025. Iran said it would attack any ship passing through the Strait of Hormuz. And since roughly 20% of the world's oil goes through that narrow waterway, tanker traffic basically stopped. Gas prices followed. The national average hit $3.11 per gallon on March 3rd, an 11-cent jump overnight, the biggest single day spike since Russia invaded Ukraine in March 2022. Wholesale prices, what gas stations pay before they sell to you, went up even harder, raising 25 cents in a single morning. One industry analyst called it a whiff of panic among the people who supply gas to your local gas station. Here's the key number to remember. Economists at the Dallas Federal Reserve estimate that when crude oil goes up $10 a barrel, gas at the pump goes up about 25 cents per gallon over the next few weeks. Crude is up $10 to $12 since the strike started. So expect gas prices to keep climbing, maybe to national average $3.25 to $3.50, depending on how long that waterway stays blocked. The stock market has been jumping around a lot also, but it's not falling off a cliff. On the first day of trading after the strikes, the Dow dropped 600 points at its lowest point, but fought back to close down only 73. Investors actually bought the dip, meaning they saw lower prices as an opportunity, not a disaster. The next day was rougher. The Dow fell over 1,200 points in the morning before clawing back to close down about 400. By March 5th, the Dow dropped another 785 points as oil pushed through $80. The hardest hit, airlines, down 5% or more. Countries that import a lot of energy got crushed. South Korea's stock market dropped 7% in its worst day since the 2008 financial crisis. European markets fell 3 to 4%. European natural gas prices nearly doubled in 48 hours before pulling back. But, and this matters, tech stocks have actually held up pretty well. Big companies like Nvidia and Microsoft saw people buying when the prices dipped. Defense stocks, companies that make military equipment, no surprise, jumped 5 to 10%. Energy stocks are up nearly 30% this year, and Berkshire Hathaway, the company built by Warren Buffett, widely considered the greatest investor who ever lived, started buying its own stock back for the first time since 2024. That's a signal from the smartest money in the world that it sees opportunity, not danger. Here's the context that nobody on social media is giving you. A team at Carson Group looked at 40 major world crises over the last 85 years, from Germany invading France in World War II to Iran attacking Israel in 2024, and calculated what the stock market did afterward. On average, the market lost less than 1% in the first month, then gained 3.4% over the following 6 months. Past results don't guarantee future results, but the pattern is clear. World crises cause short-term shaking, not long-term destruction. And I want to note this is not financial advice. Please speak to a financial advisor who are certified to direct your financial needs. I do have a financial um, software, an app coming out soon that I will be posting in the description once it's fully available. In any case, Wells Fargo's worst case scenario, a long term shutdown of that waterway was pushing oil above $100. Projects the stock market could fall, project, excuse me, the stock market could fall about 13%. That's real, but it's recoverable. Their most likely scenario is still has the market growing by year end. Now, I just hit you with a lot of numbers and a lot of facts and a lot of, news. And I want you to notice something about how you feel right now versus how you felt scrolling your phone this morning. When I lay out the data in order, with context, with historical comparisons, with both worst case and the likely case, feels different than when you see a headline screaming Dow plunges 1,200 points. The data is the same. The way it's presented, what we call framing, is different. And framing is how your money gets stolen, not by the market, by your own brain. So when I was at no, Merrill Lynch for those, the layman's, I learned something they don't teach any finance textbook. The biggest threat to your money isn't the market, it's you specifically. It's five mental shortcuts your brain takes during a crisis that end up destroying your wealth with surgical precisions. Let me walk you through each one because I guarantee at least two of them are messing with you right now. Brain glitch number one: losing hurts twice as much as winning feels good. Here's something that won a Nobel Peace Prize. Researcher Daniel Kahneman and Amos Tversky proved that losing $100 hurts your brain roughly twice as much as gaining $100 makes you feel. This isn't a figure of speech. They can actually see it on brain scans. The fear center of your brain, the amygdala, lights up stronger for losses than it does for gains. Psychologists call this loss aversion. Your brain is wired to hate losing more than it loves winning. What this means during a crisis, when you look at your retirement account and see red numbers, your brain process that as pain, real physical level pain. And your instinct is to make the pain stop. The fastest way to make it stop, sell, move to cash. The red number disappears, pain over. Except it's not over because now you've made the loss real. The drop was temporary, like your house losing value during a bad real estate year. But by selling, you made it permanent. That client I told you about, he turned a loss that only existed on paper into a loss that was real and irreversible because his brain couldn't handle watching the number go down. Here's what I used to tell my clients: your investments are like your house. If someone told you your house lost 15% of its value today, would you sell it tonight? No, because you know the value will come back. Your investments work the same way. The value is still there. The price is just on sale. Brain glitch number two: whatever just happened feels like it'll last forever. Your brain gives way to much weight. Your brain gives way too much weight to the most recent thing you saw. If the market dropped today, your brain assumes it'll drop tomorrow and the next day and forever. It can't picture the recovery because all it can see is the decline. Psychologists calls this a recency bias. Your brain treats the last thing that happened as the most important thing that's ever happened. During COVID in March 2020, the stock market dropped over 30% in weeks. If you sold during the panic, you missed one of the fastest recoveries in market history. Stocks were back to where they started by May 2020, less than 2 months. People who panic sold at the bottom and waited until things felt safe before buying back in missed 60% of the recovery gains. If you had bought in when the market dropped that much, you would have made significantly more money. Right now, your feed is showing you oil spikes, market drops, and gas price surges. That's the recency bias machine running at full speed. What it's not showing you is the 85-year pattern where world crisis cause short-term pain followed by recovery because recovery doesn't get clicks. Brain glitch number three: when everyone runs, you run too. When markets drop, you feel a powerful pull to do what everyone else is doing: sell, get out, run to safety. This is the same instinct that made our ancestors sprint. when the rest of the tribe sprinted. Because back on the plains, whichever plains you want to go, whether it's Asia or Africa, the person who stopped to think about whether the danger was real got eaten by the lion. Psychologists call this herd mentality, following the crowd because it feels safer than standing alone. But in financial markets, the crowd is almost always wrong. When things get extreme, when everyone is buying, prices get pumped up too high. When everyone is selling, prices get pushed down too low. Warren Buffett, most famous line, says it perfectly. Be scared when others are greedy, and be greedy when others are scared. Here's the number that should stop you cold. Investors who held their positions through the 2008 financial crisis and the worst crash in modern history, watched their money grow by an average of 400% over the following decade. 400%. But most regular investors didn't hold. They sold at the bottom because everyone else was selling. They followed the herd right off a cliff. Brain glitch number 3. You get stuck on a number that doesn't matter anymore. Here's one that trips up even smart investors. You bought an investment when it was worth 500,000, now it's worth 440,000. Your brain is glued to that 500,000 number. Everything feels like a loss measured against it. Psychologists call this anchoring, when the first number you see becomes the measure stick for every number after it. But here's what's a clear thinker asks. Is 500,000 even the right number to compare it to? What was that investment worth 2 years ago? Probably less than 440,000. You haven't actually lost money compared to where you were 24 months ago. You only lost compared to a peak that might have been temporarily pumped up. At Merrill Lynch, I watched clients who had turned 200,000 into 500,000 over 10 years completely melt down when it dipped to 420,000. They couldn't see the 220,000 they gained. All they could see was the 80,000 loss, the anchor. That $500,000 peak blinded them to reality. Brain glitch number 5, the need to do something, anything. During a crisis, doing nothing feels irresponsible. Every fiber of your being screams, act, move, protect yourself. Psychologists call this action bias, the belief that doing something is always better than doing nothing, even when the evidence says otherwise. But when it comes to investing during a crisis, the evidence is overwhelming. Doing nothing is usually the smartest move. A JP Morgan study found that if you miss just the 10 best days in the stock market over a 20-year period, your total returns got cut by more than half, more than 50% of your money gone. And here's the kicker. Those best days almost always happen during or right after the worst days. If you sell during the crash, you miss the snapback. And the snapback is where the money gets made. I learned this in New York City, not just in Wall Street, but as a cop. The instincts during the crisis was to rush in, do something, take action. But my training also taught me sometimes the smartest action is inaction. Assess, observe, wait for information. The officer who rushes in without information gets himself or someone else killed. The investor who trades without a plan gets their savings killed. Same principle, different world, same psychology. All right, so enough about what not to do. Let me give you a specific system for what to do with your money right now. And I want to be crystal clear, I am not a licensed financial advisor anymore, giving you personal investment advice. I'm a former wealth manager teaching you the thinking process behind good financial decisions. Your specific situation needs your specific analysis. What I'm giving you is the framework for that analysis. Got it? Good. I call this hold protocol, HOLD. 4 steps plus a bonus question that separates the amateurs from the professionals. H. Halt all emotional decisions. Step 1. Do not make any money decisions today. Not one. Don't sell, don't buy, don't move money, don't call your broker or wealth manager, don't open your investment app. This is the money version of the box breathing I taught in a previous episode. Before you look at any financial information, you need to get your thinking brain back online. That takes at least 24 hours after something scares you. When you saw the headline about the Dow dropping 1,200 points or your account balance going down, the fear center of your brain fired. It's running the show right now. Let it calm down before you make a single move. Rule of thumb from my Merrill Lynch days: if the urge to act is strong, that's usually a sign you should not act. The stronger the urge, the more your emotions are in the driver's seat. Powerful urge to sell, don't sell. Powerful urge to panic buy gold, don't buy gold. Wait, think, then decide. O, organize what you actually own. Most people can't tell you what's in their investment accounts without looking it up. During a crisis, they see a number going down and they panic without knowing what is going down or why. This week, sit down and write out exactly what you own: what stocks, what funds, what bonds, how much cash, how long until you need this money. Next year, next 5 years, 20 years, just write it down. How long until you need this money? Because here's the truth. If you don't, excuse me, need this money for 15 years, a 10% drop today means almost nothing to your 15-year outcome. The stock market has recovered from every single major drop in history when given enough time. Everyone, in- including the Great Depression in 1929, including the 2008 crash, including COVID in 2020. The only people who lost permanently were the ones who sold during the drop. Now, if you do need your money in the next 6 to 12 months, that money shouldn't have been in the stocks in the first place. Crisis or no crisis, that's a planning mistake, not a market mistake. L, look at the actual numbers, not the headlines. The headlines saw Dow plunge 1,200 points. That sounds like a world is ending. But what's 1,200 points when the Dow is sitting at 48,000? It's about 2.5%. A 2.5% daily drop is uncomfortable, but it's not a crash. The Dow has dropped 2 to 3% in a single day hundreds of times in its history. It's noise, not a signal that the sky is falling. Same thing with oil. Oil surges 13%. Sounds terrifying until you realize oil went from about $70 to about $80. In 2022, after Russia invaded Ukraine, oil hit $130. In 2008, it hit $147. We're not even close to real crisis level oil prices yet. Could we get there if the strait stays closed for weeks? Yes. Is it guaranteed? No. And here's your assignment for the next 2 weeks. Every time you see a money headline, convert the number from points to a percentage and compare it to what's happening before. Dow drops 785 points, becomes Dow drops 1.6%. This one habit will cut your financial anxiety in half because most of what sounds like a catastrophe in points is a normal day in percentages. And finally, D, diversify your anxiety, not just your investments. When I say diversify your anxiety, I mean this. Most financial panic comes from staring at one thing, your stock account, and ignoring everything else in your financial life. Do you have savings set aside for emergencies? Do you have money coming in from a job? Do you own your own home? Do you have skills that people will pay for? Do you have people in your life who care about you? All those things are part of your real wealth. and none of them changed because the Dow dropped 2.5%. One of the most powerful exercises I use to do with clients, write down everything you own and everything you can do that makes money, not just your investment, your home, your car, your education, your skills, your relationships, your health. When you see the full picture, the stock market drop feels a lot less like the end of the world. The stock market is one piece of your financial life. Right now is being presented to you as if it's the only piece. That's a framing trick, the same kind we talked about in my previous episode. And here's a bonus step, the contrarian question. So here's the final step, and it's the one that separates everyday investors from professionals, or what we called in Wall Street institutional investors. After you halted, organized, looked at real numbers, and broadened your view, ask yourself this one question. If I had no investments at all right now, and I was looking at these prices for the first time, would I buy? Think about that. If these companies are still sold, still making money, still growing, then then why would you sell what you already own at a lower price than what you paid? You're basically saying, I wouldn't buy this at $80, but I'm happy to sell it at 80 even though I bought it at 100. That makes 0 sense. But under emotional pressure, millions of people do it exactly that every single crisis. Fun fact, when I was at Merrill Lynch, I advised all my clients in 2008 to buy Citigroup's stock when the financial crisis happened. Why? Because Citibank was in the White House, was in congressional hearings, but was being highly supported by the Federal Reserve as well as the White House. I knew they weren't going anywhere. And the terms too big to fail was being thrown around by government officials who had power and weight in Congress. That being said, I bought the stock, I believe, before the split adjustment. It was around $7. It's which is equivalent to around $20 to $30 range. Now, the stock price is at of the closing of March 17th, 2026, $107.71. More to that, Berkshire Hathaway's new CEO, Greg Abel, started buying his company's own stock this week. He talked to Warren Buffett before doing it. The most legendary investor in history looked at these market conditions, and his response was buy, not run, not hide, buy. That's what a decision made by a thinking brain looks like instead of the fear brain. I know what some of you are thinking also. Mike, that's great for people with investment accounts, but I'm worried about my gas prices. I'm worried about groceries. I'm worried about making rent. I hear you. Let me speak to that directly. First, let me say this, the concern is real. Gas prices are going up. If they keep rising, and they probably will for the next several weeks, that's real money out of your pocket. A 25-cent per gallon increase costs the average American driver about $30 to $40 more per month. For families already stretched thin, that's not nothing. As one economist put it, rising gas prices hit hardest on the people who can least afford it. But here's what I need you to hear. Panicking makes it worse, not better. When people start panic buying gas, filling up extra containers, topping off tanks that are already half full, driving across town to find a cheaper station, they create the shortage they're afraid of. It becomes a self fulfilling prophecy. The fear of running out actually causes the running out. The gas supply to the United States hasn't been cut. What's happening is that future prices are rising because of the expected problems down the road. The actual supply chain to your local gas station is still working. Now, I'm not going to tell you exactly what Stephen Colbert notably stated in March 2022, that he's not concerned about the gas prices because he drives a Tesla. But what you can do right now is fill your tank when you normally would. Not out of fear, regular fill-ups, don't hoard. Cut unnecessary driving for the next month. Combine your errands into one trip. Carpool if you can. This isn't forever, it's a temporary adjustment. Go through your subscriptions and monthly charges. Most people have $50 to $100 per month in subscriptions they don't even use anymore. Cancel them. That covers the gas increase. And if you're truly struggling, look into local and state help programs. Many states have emergency fuel assistance that helps most people, and they don't even know it even exists. And most importantly, do not make big financial decisions. Buying a car, switching jobs, taking on debt based on a crisis that's been going on for 1 week, the worst money decisions are the ones made in the first 2 weeks of a crisis. Let me tell you what I tell my staff at my school. When something goes wrong, focus on what you can't control. Control the controllables. Let the rest work itself out. You can't control oil prices. You can't control the waterway in the Middle East. You can control your spending, your reactions, and your decisions. Put your energy there. And now that I think about it, my app actually would be complete by the airing of this episode. So look at the description. It is 100% free. Please try it out. It's a web app. It will be on Google Play and Apple Store in the near future. But for now, you can actually go to it. So please check the description below. But moving on. Let me close with the story from 2008 because I think it's the most important money lesson most people never learned. In September 2008, Lehman Brothers, one of the biggest investment banks in the world, collapsed. The market went into a free fall. The S&P 500, the index that tracks the 500 biggest companies in America, eventually dropped about 57% from its peak. It felt like the end of the financial world. I was in it. Merrill Lynch survived the Great Depression, but couldn't necessarily survive that crisis. That's why BlackRock, Merrill Lynch split because Bank of America bought them out. People were terrified. Clients were calling every day begging to get out. The people who panic sold at the bottom, and millions did, turned a temporary crisis into a permanent wealth destruction. They sold their stocks at 40, 50, 60% loss. Then they sat in cash, too scared to get back in, while the market started recovering. Then, years later, when the market had already recovered most of its losses and the news was finally positive again, they bought back in at or near the prices they had originally sold it at. They felt the full pain of the crash and missed the full benefits of the recovery, the worst possible outcome, not because the market betrayed them, but because their own psychology did. Meanwhile, the people who held or who had the discipline to keep putting money in during the crash, or at least dollar cost averaging, watched their money grow by 400% over the following decade. 400%. $100,000 that survived 2008 was roughly half a million by 2019. The 2008 crisis didn't destroy wealth. The reaction to the 2008 crisis destroyed wealth. And right now, in March 2026, the same reaction is being triggered by the same brain glitches and the same brains. The question is, are you going to be the client who panicked or the investor who held? So here's what we covered today. We looked at the actual financial numbers, oil prices, gas prices, market moves. With context and historical comparisons instead of just scary headlines, we identified 5 brain glitches that destroy people's money during every crisis: loss aversion, losing hurts as much as winning; recency bias, the least thing you saw feels permanent; herd mentality, following the crowd off a cliff; anchoring, getting stuck on a number that doesn't matter anymore; and action bias, the urge to do something when doing nothing is smarter. And I gave you the hold protocol: halt, emotional decisions, organize what you own, look at actual numbers, diversify your anxiety, and ask the contrarian question. Your homework this week, the four things: do not make any money moves for the next 7 days. Write down every urge you have. I want to sell, I want to buy gold, I want to cash out my 401k. And then don't act on any of them. In 7 days, look at that list. Most of those urges will already feel ridiculous. That's the gap between your fear brain and your thinking brain. Write down what you actually own. Every account, every fund, every balance. Knowledge kills panic. If you don't know what you have, you can't think clearly about it. My app that is free is in the descriptions below, and it can help you with this. So I highly recommend you download it. Convert every money headline you see this week from points to percentages. The Dow lost 785 points. That's 1.6%. See how the headline loses its power when you do the math. And finally, have a real conversation with someone you trust about money. Not social media, not TikTok finance, an actual human being who knows your situation. The Hold Protocol worksheet puts the clear protocol from a previous episode and where does your story start, the one that I just did last week, all in full circle. And you can find all of that information in my Substack, maaponte.substack.com. That's maaponte.substack.com. The full critical thinking toolkit, including the decision matrix, the financial decision journal, and the complete system, is available to paid subscribers. My Udemy course walks you through every framework from the ground up. It is unavailable yet because I am finalizing it, but it will be available. In order for you to know when it hits, please subscribe to the Substack as well as Thinking to Think podcast, and the links will be on the show notes. Next week, how to spot a manipulator in 5 minutes. Right now, in the middle of the crisis, someone is trying to manipulate you: a politician, a salesperson, an algorithm, maybe even someone you trust. I'm going to teach you the radar, RADAR method, the same approach I use to read people as an NYPD officer standing in the Harlem subway station at 2 a.m. when I'm able to look at a man and within 30 seconds knew he was an abuser. Before the woman he was with and said a single word, I'll teach you how to do it. Don't miss out. Until then, halt, organize, look, diversify, and question. Your money doesn't need to panic, and neither do you. I'm Mike Aponte, also known as M.A. Aponte, and this is Thinking to Think.